What if you had $204,000 in January 1966 and wanted to invest it in the S&P 500, which is the most accurate reflection of the market averages? Sounds like a dream scenario, right? Imagine having that kind of cash lying around. Do you dump it all in at once, or do you spread it out $1,000 at a time, month after month? Let's time travel and see which strategy would have made you wealthier by December 1982. Spoiler alert, the answer will completely change how you look at investing. Scenario A, lump sum investing. In January 1966, the S&P 500 sat at around 93 points. If you invested your whole $204,000 lump sum, you'd fast forward 16 years to 1982 and find the index sitting near 140 points. That's only a 50% price increase over 16 years. Yikes! With dividends reinvested, you'd be sitting at about 369,000. Total return would be 81%, and the annualized return would be 3.8% per year. Not terrible, but 16 years is a long time to wait for a mediocre result. Scenario B, dollar cost averaging. Instead, you decide, I'll invest $1,000 every month, rain or shine, until I've invested the whole $204,000. That means you buy when prices are high, but also scoop up bargains when prices tank, especially during the brutal 70s stagflation era. By 1982, you've had amassed a balance of roughly $439,000, total return 115%, and annualized return about 5.1% per year. Same total dollars invested, same time, completely different outcomes. But here's the shocking part. From 1966 to 1982, the market was practically flat, one of the worst sideways stretches in US stock history. The lump sum investor basically wasted 16 years of compounding power. The dollar cost averager quietly built wealth, beating even many professional fund managers. As Warren Buffett says, the stock market is designed to transfer money from the active to the patient. And DCA is about as patient as it gets. Why is timing so hard, you may ask? Now, to be fair, lump sum investing can absolutely crush dollar cost averaging in a strong bull market. If you dumped your money in 2009 after the crash, or in 1982 just before the legendary bull run, you'd look like a genius today. But here's the truth, nobody can time that perfectly. Not even the pros. Peter Lynch, one of the greatest mutual fund managers ever, once said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Dollar cost averaging takes that temptation away. No guessing, no stress, just steady, consistent investing. Now here's the crazy part. Most Americans are already using DCA without even realizing it. Your 401k, your IRA contributions, and your automatic paycheck deductions. All of those are dollar cost averaging in disguise. Every 2 weeks, a chunk of your paycheck buys into the market, no matter what's happening with interest rates, elections, or the latest scary headlines. And history shows, over 10 years, consistent DCA almost always yields a positive return. Over 20 years, it becomes virtually certain. Over 30 years, you're not just surviving, you're thriving. Even if you're the unluckiest person alive and start investing right now before a crash, by consistently adding, you smooth out the bumps and come out ahead. In the 1970s, people joked that the stock market was going nowhere. Business Week even ran a 1979 story called The Death of Equities. Imagine bailing out then, only to miss out on the monster 80s and 90s bull run. If you had been dollar cost averaging through the death of equities, you were laughing by the late 80s. Funny how the market dies every decade or so, yet somehow resurrects itself wealthier than ever. It's like the zombie that just refuses to stay down. Think of lump sum investing like cannonballing in a cold swimming pool. If you jump at the wrong moment, like when there's no water, it's gonna hurt. Dollar cost averaging, on the other hand, is like dipping your toes in slowly but surely. It may not feel as dramatic, but you'll actually enjoy the swim instead of breaking your neck. Here's a balanced view. Lump sum, best if you've got money, nerves of steel, and maybe a crystal ball. Dollar cost averaging, best if you're human. It trades some upside potential for much lower risk and a near certain outcome. Buffett again said the best time to plant a tree was 20 years ago. The second best time is now. The tree doesn't care whether you plant one big seed or many small ones, but watering it consistently. That's what makes it grow. Let's circle back to our 1966 investor. Lump sum, $204,000 grew to $369,000. Dollar cost averaging, $204,000 grew to $439,000. In one of the flattest markets in history, DCA didn't just survive, it won. So the lesson is, if you want to play the market timing lottery, lump sum might make you rich. But if you want to build wealth with certainty over 10, 20, 30 years, dollar cost averaging reigns supreme. Here's my question to you. Would you rather gamble on hitting the jackpot with perfect timing or quietly and consistently build wealth that beats most pros? Drop your answer in the comments and smash that like button if you want more no BS investing breakdowns. And here's another fun fact. Did you know Warren Buffett bought his first stock at age 11? He later said, "I wasted my life up until then." Imagine what he'd say about waiting 16 years in a flat market with a lump sum. Disclaimer, this video is for educational and entertainment purposes only. It is not financial advice. Always do your own research or consult with a licensed financial advisor before making investment decisions. This is your financial watchman, signing out.